Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the EIA show, we're going to talk about the draws that we had. We had a really big crude draw. We want to talk about why did that happen. For those that remembered from last week, we were saying that we expected to see a big spike in exports, and we did get that. It was over 4 million barrels a day. Some of that, again, was kind of that catch up because the numbers were just a little too low. Like, it didn't make much sense. So there was some catch up in that number. There was some of that movement, which is a net positive. But when you look, you had imports that were down again. You had exports that just surged. So we had a nice crude draw. We want to talk about what's going to come next, how much of that is going to continue, and then we're going to look at obviously gasoline and distillate, where are some of those, because we did get some more draws in there. Then we're going to talk about where's the product demand, and product demand still remains a bit sluggish. We want to look at where is gasoline demand going, where's distillate demand going, and then obviously the jet fuel side. And then we'll obviously wrap in some propane, and then when we go to the international market, we want to talk about how, again, those U.S. exports spiked, why they spiked, where they're going, and then we want to look at what's happening with Russia, because Russia continues to dump a lot of crude into the market, and we really want to look at those flows, especially when we look at Urals and other products heading into the Asian markets. So before we get into our normal piece on segment one, we want to provide an update for Libya. So for anyone that isn't following Chris Stevens, he's at Reporting Libya on Twitter. He's been on top of this from the beginning. So we want to look at the force majeure that has happened. Libya, the prime minister has ordered armed forces to end protests. And to be clear, this is right after there was a plan that was outlined to take Libyan production to 1.4 million. So some of these protests were obviously over pay, over where things are going. So they're essentially, it's a good time because it's like, all right, well, you want to increase production to 1.4 million barrels a day. I want to get paid. So that's what they're using right here. So the map shows protests, which are circled. The NOC, the National Oil Company, declared force majeure, 4 in total. Right now, when you look at production has gone from about 1.2 million barrels a day to about 800,000. There's enough product in storage to keep exports flat, but the longer this goes on, then obviously exports, that's going to go from that about 1.1 million, to about 800. Then obviously the force majeure at the ports right now will then cause some of this to slip into May. It's all going to come down to when do they come to some sort of an agreement, or when do the protests end? Because happening for a day or two, there's enough time left in April to kind of to speed that up. But if this continues through the next let's call it the next 2 or 3 days, you're going to see some of those force majeures that we're talking about on the coast. They won't be able to catch that up, and that'll cause some of that some of the slowdowns, and that'll get pushed into May. But this also becomes a bigger issue because when you look at Europe and the comments that Europe wants to ban the imports of Russian crude, Libya was going to be a big piece of how they can try to get away from that, with a lot of this flowing into Italy. And again, this is why it's another important piece to look at. So as we talked about last week, total oil and product stocks, they moved a bit higher on the back of crude increases. We had some big increases in storage in both the U.S. and Europe from 2 weeks ago, which is where this is counting. We've now seen that reverse. So again, you're gonna see that just essentially sit right at the bottom of that cloud. Still within kind of that piece, just when you start looking at where is everything on the offshore side and on the onshore side. So here's where you're going to keep that a bit higher. Deficit narrowed in total from 127.3 to 104. The deficit narrowed in crude, on the crude front, from 52 to 29.3. But then when you look at the on the product side, the product deficit narrowed from 75.3 to 74.7. Both of those opened back up last week. So again, that's where we're going to see some of that widen. Product stocks continue to be in a very bullish scenario. Not as much on the gasoline side, especially on the west of Suez, but on the diesel distillate side, things still remain robust, and we'll talk about that again in a minute. India's diesel exports in March were the highest since April 2020, when they hit 847,000 barrels a day. So again, you're starting to see some of the movements. You're starting to see some of those shifts. European gasoline arrivals in the U.S. gained in the 7 days through April 14th. They continued to rise, climbing to the highest in 3 weeks. Total European gasoline imports rose to 228,000 barrels a day into the U.S. And some of that's going to continue to increase, because Pad 1 is really going to be that dumping ground, given the fact that Europe is sitting on a record amount of gasoline. We do expect some of that, as they try to manage where that storage is, some of that will come from Europe into the U.S. markets, which will keep some of that moving through. Now, about 30% of India's diesel have ended up in Europe, where prices of ultra-low sulfur diesel were $100 a ton costlier than in Singapore. So again, you're seeing some of that movement. But if you look at the Indian-Ural situation, if they, again, not to say that sanctions are going to happen on India, but there's been pressure on India to stop buying Urals, and we just don't see that happening. India is going to stay very firmly, and I'm saying very firmly, neutral. But when you look at Europe, Europe has to also replace Russian diesel. So you need Indian diesel. So you're going to sanction both. Again, this is where it gets very complicated when you look at some of those different pieces. So now when you start looking at land, turning to the land storage side, deficit narrowed from 81.5 to 76.1. You can see that on a seasonally adjusted basis, we should be increasing. It's just the rate of change, very stable, still outside that cloud. And that's not something that we see changing at this point. West of Suez, the weekly build was there. So the deficit narrowed from 70.9 to 62.6. Now that deficit is going to widen when you look at what happened this past week, when we look at the EIA having a drop of 8 million barrels, and then when you look at Europe having a drop of 5. So again, that's going to widen out. East of Suez, deficit widened from 16.6 to 19.7, pretty much holding right where we were in 2021. And again, we don't see that changing at the moment. Now, this is the interesting one when you start looking at the floating storage side. Surplus narrowed from 34.7 to 24. We're still just below 2021, still elevated for where we should be at this point in time. And then when you look at floating storage west of Suez, the surplus widened from 1.6 to 2.7. That widened again this past week. So again, that's why when you look at Europe onshore dropped, but Europe offshore increased, and then that'll obviously swap. Floating storage east of Suez, surplus narrowed from 33.9 to 27.5, but we're getting an increase in the amount of cargoes that are signaling, and I think we're at about a 2-month high for super tankers heading to China. So again, we do expect the floating storage east of Suez to go back up. Middle East floating storage has actually had a fairly sizable increase, and that's not surprising when you look at the OSPs, or the official selling price, in which you had some of that big increase in pricing that Saudi Arabia and Kuwait pushed through. Where Iraq, as we talked about in the insights, Iraq actually kept their prices. They increased them, but not to the same level, which should help some of their flows into both Europe as well as into Asia. So now when we turn to the crude stocks, which had a draw, here when we look at the draw in general, there was a drop of 8.02 million barrels. That's 92.3 million below the 5-year average. It is all really being driven by Pad 2. Pad 2 had a drop of 1.41 million, bringing us 32.8 million below the 5-year. Cushing, only that small drop of 180,000 barrels. And if you remember what we were talking about last week, and over the last few weeks, is we expect to see some steady builds, but again, just an increase of 700,000 barrels, a decline of 200,000. It's never gonna be a straight line. It's just kind of this, call it the chevron pattern, higher, with higher highs, higher lows as they move up. But even with those increases, We're still 23.8 million below the 5-year average, again, keeping us there. And then when you look at Pad 3 had a drop of 3.5 million, bringing us 26.3 million below the 5-year average. And a lot of that is going to be balanced. And we'll show the chart in a few minutes where we look at Pad 3. And one of the things that we've been saying is we expect everything to just kind of go flat at this level. And we don't, and it's just going to be a balance of, okay, well, where are the exports going? How fast are the exports leaving? Where are the imports? And they're never going to match up because, as we've talked about, the Houston Ship Channel is narrow. A lot of the waterways are narrow. So if you have a huge export number, you're going to have a small import number. So now that we've had these big exports, small imports, now we'll have the reverse, and we'll have exports coming down, imports coming up. And that'll kind of offset some of this. Again, there's still going to be in this, let's call it a fairly volatile move, but that's where we see this continuing. Now, West Coast had a drop of 2.39 million. That is, again, the lumpiness that we've talked about, and that brings us to only 4.3 million below the 5-year average. So again, Pad 2 Cushing, Pad 3 is really where we're seeing that drop. Now, when we look at and factor in the SPR had a sizable release this past week. So when you factor in the SPR draw, we're 12.72 million. The total draw was 12.72 million, but the SPR goes from SPR into commercial. So again, you're just seeing some of those movements. As we said last week, we had production at about 11.87 million. For those that have been following the EIA, the way they're doing it, they're going to the round, a round number. So going from 11.8 to 11.9 for us is just kind of a true up in terms of where we see production right now. This still puts us very much in line to hit that 12.2 million exit rate. That again is just going to, with some of that bigger push coming towards the May into the summer months, where we get a lot of that production growth, and then things kind of slow down and stabilize as we go into month end, into year end. Now, runs had an increase of 1%. They went from 90% to 91% utilization rates. This is what we were saying, where we just kind of expected to be between that 92%. There were increases that were fairly balanced between Pad 1, Pad 2, 4, and 5. We expected to see Pad 5 come back. There was the fire. There was some of that disruption. Some of that came back. So we had some increase. Pad 2 continues to be strong. With an 86,000 barrels a day additional, with Pad 3, fairly stable with just a small decline. But again, now you're going to see some of this waffling back and forth until we get into really the end of April, and then we'll see that steady grind higher where we start to move towards what will be about 96 to 97% utilization rate, which is where we should be as we get into the end of May, the first week of June. And this is what you're looking at when we look at again seasonality. So obviously we're above that 29-year average. We expect it to continue to grind higher. What we're saying in terms of levels are fairly normal. You can see that we typically get to about that 97, 98%. Depending on what period of time. When you smooth it out, you can see that there's a pretty stable move till about July, then things flatline, and then as you come out of August, you go into fall turnaround, and that's when you see that drop off that typically happens. So again, something that's very normal, just at a higher end. Imports remained weak. We had a drop of 159,000 barrels a day. That brings us 817,000 below the 5-year average, and that was really driven based on what we saw in Pad 1 as well as Pad 5. Pad 1 had a drop of 95,000 barrels. Pad 3 had an increase of 89,000. But when you look at the difference between the two, so when we look at Pad 3 had a drop of against the 5-year average of 782,000 barrels a day. And that's where, we were expecting to see an increase in Pad 3 imports, but because exports were so elevated, it's hard to see, obviously, to do it at the same time. So now as exports drop, you'll see this increase and you'll see some of this lumpiness just because, as we've been saying, there was a lot of the spread opened up. We expected some of these exports from the U.S. into both Europe and Asia. This is why we took our estimates higher to about 3.3 million barrels a day on the 4-week rolling average. So when you take what happened on the export side, if you look at last week at 2.1, now this week we had that increase of 4.27 million barrels a day. That brings us just over 3.2 million barrels a day on the 4-week rolling average. Again, kind of holding right in line. So we do expect to see PADD 3 imports increase as PADD 5, even though there was a drop on the on the weekly, it's still outpacing where the 5-year average is. So now, when you look at PADD 3 imports, here you can see that we're still at the very low end. We do expect this to continue to move higher, especially when you look at some of the pricing that has started to open up in terms of Iraq and some of the other Latin American areas. We should see some of that crude come through, as the target is going to remain focused on the distillate cut. So that's where we will see this again skew a bit heavier and be a bit supportive of PADD 3 imports. And at the same time, do the same for PADD 2. So one of the things that we were saying is we expected to, on the low end, to hit the 5-year average. On the high end, set those new records when you look at kind of how lumpy this is. So we do expect this to see an increase. Again, just it's either going to be a new all-time high, seasonally adjusted, obviously, or the low will be the 5-year average. And we do expect PADD 2, because a lot of this is coming down from Canada, where they do have the heavier crude that is in demand. So we do expect to see a lot of that coming down into the U.S. Implied demand for products, finished gasoline had an increase of 132,000 barrels a day, bringing us from 8.7 to 8.868. Very normal in terms of that increase, and actually it was below where we were in 2021. So even though we had that increase, it's still well off of where we should be. The 5-year average is obviously very, very skewed because of 2020. So when you look at where we are, we're tracking actually right where we were in 2021, which is still well off where we were between 2016 and 2019. So still not seeing that big increase. We did get that makeup number that we were talking about on the distillate side. We had an increase of 338,000 barrels a day. That brings us pretty much right in line with the 5-year average. That was driven with, we did get some cooler weather in the Northeast, as we were talking about on the weather forecast. So again, that increased some of the heating demand. We did get a little bit of that movement on the diesel front for the trucking side. So that's going to remain fairly stable. When you look at jet fuel, we're right between that 1.45 to 1.55. We expect to stay within that range as we go through the remainder of really through into the rest of the spring, and then we'll get a little bit of that increase as we go into the summer months, or vacation season, if you will. Propane, same thing on the weather front. You had an increase of 254,000 barrels a day. That's 192,000 above the 5-year average. Demand is going to remain robust, so we do expect to see that remain elevated as we go through the remainder of the year. And this is just looking at the U.S. gasoline implied demand. So you can see how the 5-year average is obviously pulled down by that huge swooping down move in 2020. But you can see we're just off of 2021 levels, and we expect it to see a steady increase. We are in springtime. There, we do have the spring break this week. So again, that's going to support some of that additional movement. For those that have been driving around, there's obviously school is out, people are moving about. So we'll see that steady increase, and then we'll see some of that drop off. And then obviously as we head into Memorial Day weekend, then you'll start to see those increases just as we did in 2021, even though it was still below where we saw things on what, let's call it just a normal period between 2016 and 2019. So still at the lower end. And then when you look at crude oil inventory, this is what we were talking about as we kind of went through. We expected it just to kind of go sideways, get a little bit closer to that 2018 number, and then just stay fairly flat. So we had that big increase, now a decrease, and we're just going to see this remain fairly stable as we go through the remainder of the spring. Days of supply for crude oil, it's a week, the week lag. So as we said last week, we expected this to come back up, and then with the decrease in crude stocks, the increase in refining, that'll come back down and keep us just above where we were in 2018. Now, when you look at commercial stocks, this is factoring in both crude and let's call it driving or mobility products. And this is again taking crude, gasoline, distillate, residual fuel, and then jet fuel. So you can see that we're still getting that steady move down. We do expect that to flatline a bit, especially with the weather changing for the diesel side, or for the heating oil side, gasoline still remaining a bit lackluster, and that import shift, but again, still in a positive momentum. Now, when you look at gasoline storage, so gasoline storage had a drop of 760,000 barrels. That's still well within kind of that 2021 level. We expect it to flatline here. We should get one more pull just because this is spring break. You will have some people driving home. So we'll get one more move, and then again, we expect to flatline and move very close to where we were in both those 2018, 2020, 2021 numbers. Distillate, on the other hand, continues to move lower. We're pretty much in no man's land at this point. This has also been because we've been exporting more product. The market is flush and very profitable, so it makes sense to again trying to take advantage of that. And it doesn't. I mean, we don't think that's going to end. Diesel prices are going to remain elevated. We'll show pricing in segment 2. So again, that's going to keep things moving off the coast, which is why refiners are going to want to try to target and maximize that barrel so they can take advantage. But again, that's also going to be that competition. And we normally get some of this flatlining just because you have demand coming down with heating oil. Trucking still remains, still continues to weaken. And that'll again, we'll put some into storage, which will then offer up some more for the export market. Jet fuel side, even though it looks a little bit bouncy, obviously it's always volatile. We're well off the 5-year average, but again, they're just going to manage that based on what is in the disti cut, what is in the kerosene pool, and how are they going to view that and when we look at the airline data in the next segment, you can see that things still remain well off of 2019 levels, and we don't see that closing. On the futures curve, you can see that we're still above to the 90 as we go through the rest of this year, above 80 through essentially the middle of 2024. So still a healthy curve when you look out. And then the curve still remains robust in the belly of it. And when you look through the remainder of it, it's still well above 65. So again, still a lot of premium priced in. The front month is just going to continue to be volatile, as we were saying before, and for those that we've talked about with clients, it's essentially above 110 you're selling, below 100 you're buying, and you're just going to stay within this fairly volatile band. As we saw yesterday, we were down $6. Again, you'll see headlines of, demand issues. But again, who doesn't know about demand issues? When you look about, supply issues, which is going to take us up. Demand issues are going to push us down. Just play the vol, play what's given to you. So again, that's something that we continue to see. Now, when we look at COVID, here you can see that COVID continues to wind down. As the weather changes, things should get a bit better again in the U.S. We've had a small increase, but again, it's been kind of waffling back and forth. As summer comes, it'll be interesting to see, do we get some of those increases down south? But for those that have had it or have continued to have it, it doesn't have the same type of fear factor, and we don't see things adjusting very much. Asia Pacific flatlining a bit. Thailand, Vietnam, South Korea. South Korea is starting to open back up, so we are seeing a bit more gasoline pull into there. We'll talk about that in segment 3 as mainland China continues to struggle with an outbreak and their zero COVID policy. So now when we look at what is happening on the crude oil in PADD 3. We're right in line with 2019 numbers. Again, we're still at the high end. I should say the high end for 2021. For 2022, we just don't see that changing. As we were saying before, we expect that to be a balance between big exports, additional imports, production flowing down. So again, we're going to have some of that movement and stay fairly stable. Here we are with Cushing, again, as we were saying, just kind of that lumpy move higher, and we expect that to continue. And then when we look at floating storage increased. We're now above 2021 levels. And again, that comes down to timing. We had a huge export push. Now you had to wait, you had to sit there and let for some of those cargoes come through, and now you'll flow back in. So that's what we have for the kind of the brief overview. Now, next segment, we're going to go deeper into what is happening with U.S. refined product demand.